we are in a credit bubble. And it so happens it's the largest credit bubble in history. It's truly global, far larger than anything between 1927 and 1929, which led to the Depression when that unraveled. This is so big because successive credit bubbles since 2000, no, since 1985-ish, when we had Big Bang in London and everything became a lot more financialized in terms of banking. There've been about six or seven of these sort of bubbles building up, and they've always been, if you like, kicked into the next one rather than allowed to wash out the malinvestments and the banks and the businesses which really should go bust. I mean, it's when a bubble ends, you get a cleansing operation, and that just hasn't happened. So the result is that it's all rolled up into this mega, mega, mega bubble. And another reason that it's, I think, desperately important to point out that there is a difference between money, which I call a medium of exchange with no counterparty risk, and credit, which always has a counterparty involved. So, if you own a bank deposit, it's because the bank has a liability to you. You don't actually own it. It's just credit from the bank. And because of all the propaganda, particularly when Bretton Woods ended, the propaganda, particularly from the US government, has been gold is a pet rock. It's no longer central to the international monetary system. The dollar is the new gold, as it were, which is not the case. So with this credit bubble literally teetering on the edge, and the thing that will push it over is higher interest rates, you can see that it's time for a wake-up call. And those who don't understand the difference between money and credit, don't even understand money, really, it's very important that they do to protect themselves.
So let's talk about those higher interest rates, which you think could potentially be the pin to pop that bubble. So
Mm.
interest rates in the US have spiked over 5%. A lot of people were warning that this would cause a problem for equities, and yet stock market, equity markets seem to be doing all right at the moment. So first of all, how big do you think the pin needs to be to pop this bubble if this is kind of a larger bubble than we've seen before? And do you think only interest rates are the thing that can do it, or is there something else that can kind of pop this bubble?
Well, I'll answer the first question first. I have observed over the years that at the end of a bull market cycle in equities, you get both bond yields and equities rising at the same time. You then sometimes get a pause in the rise in bond yields, which allows equities to go even further, more extreme. And then when yields start rising again, it's at that point that the equity bubble gets popped. I mean, I've noticed this so many times over the 60 odd years I've been involved with the securities industry, if you like. So I think that's the first thing to understand. The second thing to understand is that credit is very much like anything else. If you restrict the supply of credit, then the cost of credit, in other words, interest rates, will rise. And we're seeing this manifest itself in various ways. I mean, firstly, the banks are no longer keen to lend on, to local businesses. So the sort of 80% of an economy, which is local businesses, if you like, rather than the big corporations, has been starved of capital and the liquidity, if you like, in order to carry stock and all the rest of it. Typically the sort of the problems, if you like, of a local retailer. And with some of the smaller and medium-sized enterprises on a local basis, which have an overdraft facility with the banks are turning around and saying, well, we want to cut this down. I mean, we would like to see your account run back to balance. But until that time, I'm afraid we're going to have to raise the rate at which we lend to you. And we're only going to lend you half as much. So you're getting these restrictions, if you like. the heart of this is that banks have now moved from a period of being greedy for business to being cautious about risk. And when they're cautious about risk and they assess that risk is more important, if you like, than opportunities in terms of lending, then, you find that the interest rates that they charge will start rising. And that has actually been the case for a little while now. The other thing you see is that they will move their balance sheets. I mean, because collectively they can't actually get rid of any credit. I mean, once it's in existence until someone goes bust and defaults. That's the only way it really goes. So what they will tend to do is to switch their lending from local businesses, small and medium-sized enterprises, etc., to governments who are, according to the regulators, less risky than lending to commercial enterprises. So everything is actually working against the productive side of the economy in that sense. And the other thing they do is they try and reduce the duration of their assets. They would rather be rolling over things on a more sort of cash-like basis than, let's say, lending stuff 5 years out. So this is the other problem, and it's raised a problem for governments because they've had to raise their debt principally out of treasury bill type instruments rather than longer maturities, which would give, if you like, a sort of a nice stable profile to their overall debt. So this is I mean, it's really quite simple. A lot of people think that the Fed or their central bank manages interest rates. Well, they can do something at the front end if we ignore the consequences. But when it comes to the longer end, they can't actually touch it. I know that lots of people talk about yield curve control and all this sort of stuff, but actually, in this situation, the banks are risk averse. Their balance sheets are over leveraged compared with where they would be, if you like, at the beginning of the lending cycle. I mean, at the beginning of the lending cycle, they would be something like 8 to 10 times assets to shareholders' equity leveraged. At the moment in the US, you're looking at about 14 times. So you can see that this is a situation which makes a banker really quite uncomfortable. That is why interest rates and bond yields are rising and will continue to rise. And there's a worse problem than that because of the G7 countries, all of them, with the exception of Germany and Canada, have government debt to GDPs in excess of 100%. This is extremely difficult. What it means is, particularly with the slowing of GDP and maybe even contracting GDP, that debt to GDP number starts soaring. And foreigners who basically price the debt, government debt on international markets, don't want to buy it. I mean, because they can see that this is, the debt is rising faster, if you like, than GDP. And on that basis, the nation is in a debt trap. So this is one of the reasons why China isn't buying, and it's also a reason why the Japanese institutions aren't buying. And I suspect that this reluctance to buy US Treasury debt will actually spread to other nations as well. So with the absence of buyers in the long-term bond market, because there you've got, do you want to own dollars is the first question. The second question is, do you want to own something with such a long duration for a yield of, say, 4.8% or whatever it is that the 10-year is at the moment? The answer is probably no. And so we're going to see bond yields, particularly out along the yield curve, rising, and it's not going to stop here. I think, getting back to the core of your question about the consequences on equities, I think once you see the US 10-year yielding more than 5%, I would be very surprised if the equity market can stomach that. I really would. And the point about this being the biggest credit bubble ever is that when it starts contracting, it's going to be unstoppable. And the consequences for all financial investments, which are all credit in themselves, I think is likely to be catastrophic to personal wealth. So that's why this matters. The relationship between interest rates and how they pop the bubble. I mean, first it's equities. Yeah, well, I mean, bonds are already, they're already suffering. Commercial real estate is already suffering. I mean, you've got another thing in the mix there, with people staying at home rather than using offices and so on. Residential property is also going to be badly hit, simply because mortgage rates are going to rise. So you can see that this is not a very happy scene. When a credit bubble goes pop, everybody gets really very badly affected. And the irony is that very few people actually know that we're in a credit bubble. It's the sort of thing they discover after the event.